All right. Welcome back, everybody. Welcome back, welcome back, welcome back. So if you're watching this, it's because there's a Fed meeting in less than 2 hours. So today we're going to talk about my predictions for the Fed meeting, some of the signals that I'm getting from the betting markets on what markets are expecting from the Fed, whether they're going to stick to this sort of 25 basis point, dip their toe in the water and see how the market reacts kind of game plan, or if they're going to go a bit more aggressive. Before we do that, quick announcements here. Our Instagram got taken down. And so a lot of you guys have been using our Instagram to stay up to date with us. It's down permanently. So we're going to create a new one. In the meantime, make sure to head over to the website and subscribe to our email list. You guys can subscribe right down here to the newsletter. We send out articles just like the one we're going to cover here about the Fed meeting. And you can stay up to date on all updates, anything Chartaddicts. That would be the best resource for you guys to stay in touch with us. Second, FX Summit 2024 is right around the corner, people. We want to see everybody out there in Dubai. If you guys have been to the FX Summit before, just leave your kind of opinions in the chat. If you guys enjoyed the experience or found it extremely valuable, just make sure to mention it in the chats to let other people know how important it is to get around that environment. November 20th is the date for the FX Summit in Dubai. Well, we're hosting a workshop in London. We just did 2,000 people in Colombia about a week and a half ago. We're going to be doing another 1,000-person workshop in London. If you or your friends, family, communities are out there in London, let them know we're coming. 1,000-person event. We're bringing out top traders, top institutional folks to be able to provide key insights that'll help you move forward towards your trading success. Head on over to fxsummit2024.com. Use promo code Chartaddicts for everything. Everything I mentioned from, any services you find on the Chartaddicts website, anything on the FX Summit, use promo code Chartaddicts, and that would be ideal to get your foot in the door and get it for the best deal possible. Okay? Now, let's talk about the Fed meeting that is 2 hours away. Here's my kind of overall view on what's happening with the Fed meeting. I think the good news is already baked in. I think we've had an insane bullish run in anticipation of a 25 basis point cut. There's been rumors flying around that the Fed might implement a 50 basis point cut. Let me see if I can get my camera on for this. So a 50 basis point cut means, so traditionally, every time there's a rate cut, long term, it's bullish for stock markets. But in the short term, no. In the short term, we typically see 1 to 2 months of bear market retracements following a rate cut. And we haven't seen a rate cut in about 4 years. And so this is going to be kind of new territory. How are we doing over here? I will give this thing a second. Okay. So good news is already baked in. That's why we've had this bullish run. The bad news, which is the Fed might choose to cut aggressively, which is 50 basis points. It sounds like it would be good for the economy. Oh, here we go. Yeah, we kind of tipped above it, but haven't broken through that little range yet. All right, the bad news has not been baked in. 50 basis points would be negative for markets because it signals that we're in a recession. If the Fed has to cut that aggressively, they typically only do that when we're in a territory of, labor market weakness. So a lot of people losing jobs, and they need to kind of stimulate the economy in some way, shape, or form. But I'm going to close partials again. So
order filled.
0.5% closed, still floating about 0.6%. If I close this right now, I'll be up about 2% for the day. Not bad. It's not much, but it's honest work. All right. But this thing right out, we're almost at TP1. But again, especially on aggressive news days, there's no guarantee that we reach that TP1. So make sure that you guys are securing partials as your plan indicates. I'm actually going to close this position in full, and then I'll just look to re-enter here if there's a retest.
Order filled.
All right. Let this thing ride out. And I'm going to add an alert here just so we know the market hits that TP1 spot. I'll also add another alert in case the market retraces back to entry. So I might have an opportunity to enter again. Quick and easy. No drawdown, just like that. Stoked for Dubai. I can't wait to see you guys out there. I'm gonna try, like, we're really working hard behind the scenes to do the coolest thing possible for Chart Addicts. Last year, we really weren't able to do that just because of how kind of hectic things were. But we're very ahead of the ball this year, and now we're kind of thinking about some of these like special experiences. So can't wait to share those with you guys and have those out there. So if we're in a recession and the Fed has to cut by 50 basis points, the market's not going to react positively to that at all. Let's actually look at something that's really important before we cover this article that I put up, kind of talking about the implications of the Fed meeting. So the biggest tool that I use is the CME Fed Watch tool. This is a proxy betting machine. I mean, all markets are betting mechanisms. In the long term, they're a weighing mechanism, but in the short term, they're all like a betting. It's a casino, and you get to kind of see the Vegas odds on what people are expecting from the market. Now, we've been covering this for a long time. And if you guys remember, probably the last 3 to 4 months, the probability of a rate cut was somewhere between 70 and sometimes as high as 90%. It was almost a guarantee that we were going to have a rate cut at some point. Now, if we look at the probabilities here, the blue indicates kind of like the highest probability thing. TP1 smashed, everybody. TP1 smashed. All right. TP1 smashed. Put something in the chats if you guys took that trade. How'd you do? Did it go well? Did it not go well? Are you happy with your execution and decision making? Let me know. Yeah, I closed at 86. And right now it's at 94. So yeah, I really could have squeezed out probably another 0.5% off this trade, but greed is not greed is not the answer in trading. It's never the answer in trading. All right. If this thing breaks TP2, I'll be a little bit upset. We'll cross that bridge when we get there. For sure. Yeah, let me know. Did you guys take the trade? Did you guys make the Moonies? What happened? Is there a new Chart Addicts Instagram account? We have a backup account that we made specifically for what is it called? For Chart Addicts YouTube. And so if you guys are interested in kind of keeping up with some of our media stuff, we still have that. We're going to have a backup account, but that was 5 years of work, 5 years of me sacrificing going out, sacrificing, parties, birthdays, all those things to kind of build that page up. And for it to just get taken in a snap and for Instagram to provide no type of support for us to get it back, because the people that basically attacked the page, they did it under something called an impersonation ban, right? So you can either do a terms of service ban, which is like what these hackers do, which is they say, all right, this page has violated the guidelines of Instagram, and they try to like kind of cook up something, and they just keep submitting reports. And then Instagram is they have like an automated system that tracks these requests. And so then you just get your account taken down if there's enough credible pages that report you. So what they do is they basically take over old accounts that have 4, 5, 6, 7 years of posting history, so they're credible, and then they use those to attack legitimate pages. It's a shitty game. Do I want to get back on that hamster wheel, build a page for another 5 years to get it kicked over like a sandcastle? No. All right. So that's why I'm urging you guys to just basically connect with us through the newsletter on email. Email's not going away. If Gmail goes down, we got bigger problems than the emails. So if you guys want to stay updated with everything we do, subscribe to our newsletter. We send out articles, we send out updates, we send out trade analysis, we send out whenever we're going live. That's something that you do not want to miss. All right, now let's see if we get a very sharp retracement back down. If this thing retraces back down about 90%, Chart Addicts members, wink, wink, inside joke. If this thing retraces back down about 90%, I'll take another entry, just catch that wick up, and then just jump out on the scalp. Okay? Just kind of a side note here. Alerts are set. Go ahead and put this at my OG entry. This paper trade is probably running fucking gazillions of dollars right now, ain't it? What was my trading panel? Oh, there it is. Oh, 75,000. Interesting. Paper trading is a trip. But you guys see the difference? It's like with the paper trade, It's really easy to just hold this thing and just kind of let it go and just leave it running because you're like, we'll just see what happens. But you have to practice how you play, even if you're doing something as atrocious as like taking, what the hell is up with my computer? Bro, that was horrendous. Okay, so gonna go ahead and cut this thing by 70%. So we'll just close 1,500 contracts. Actually, close another 200 contracts. Oh, this thing is ripping right now. This thing is absolutely ripping. Go ahead and protect this trade. Pretty easy with the drag and drop feature. And then set a hard TP. Yo, this is ridiculous. And let's set a hard target here at the previous highs. Okay. Let me see. Boom. Nice double bottom. Yup. Entry at 363 profit at 394 with a position still in. Good stuff. Solid entries. Already up for the day, just here for the call. Roman, awesome to hear. Keep your hand off that trigger, brother. I made 1.5% this morning. I'm already done. Good stuff. Took the trade, got out when you did as well. Good stuff, Janae. Love to see it. You trading minis or regulars, Janae? What about you? Are you still on there? So I got my personal account taken down, but I just got a brand new account. So if you guys want to follow me personally, it's Roy_Dunya. I'll kind of put it up here on the chats. It's right. It might look sketchy because it's got an underscore in it, but this is what we have to resort to because of these scammers. Unbelievable. My bad. We did this. This is my IG, by the way. If you guys want to follow me personally, it's Roy_Dunya. This is what we have to resort to. This is what we got to do. All right. Oh, this thing's about to smash TP2. That's insane. 414. Yeah, that would have been double the profits. Oof. It's okay, people. The goal is to walk away with money. So, job accomplished. So, if you guys want to follow me personally, this is what we have to resort to because these people just don't like to see us win. They did this. They took down the accounts because we were going to be hosting that massively successful event in Colombia. And guess what? It was still massively successful with or without Instagram. And that is the key difference between us and them, people, is that they thought this attack would be like life ruining. But that's only because they live on social media, right? We hosted a 2,000-person event with all these accounts taken down. And I'm going to remind people that, we still don't have a Chartaddicts account. We're still going to have over 1,000 people in London in about 2 weeks. Make sure to register in the link below. Use promo code Chartaddicts for free registration. Oof. This thing could really continue to rip up for another 100 points. I'm just letting y'all know this thing could rip up all the way. This thing could rip up all the way. So we'll see. That's the line of defense. If you guys look left, that's the range that we kind of started with. This is the average trading range. So my Chartaddicts members, just to kind of like, I know this is really messy. So most people watching this on YouTube are going to look at this as just an absolute mess. For us, it doesn't get any easier than this. Put it in the chat. What is this? What's this right here? And what's this right here? I'm talking about the Zoom chat here. I'm talking to the members. Yeah, JLP. Okay, good answer. Solid stuff. This thing is ripping through, bro. I think it might actually push to the top of the range. But if that's if this is our range, then what is this right here? What would be this area called? If this is our range, what's this area here? Okay, beautiful. It's either that or it's the average trading range. This is where most of the activity happens. If you pull out, the easiest way to see this is I see a lot of people, like I visualize this on the charts, but I see a lot of people using a volume indicator, a session volume indicator, kind of like on the side. And what you'll notice is, I'm going to pull it up here in a second, but if I was to take a guess, it would look something like this, and then it would have all the big volume here, and then you'd have the smallest amount of volume towards the edges. Okay, it kind of look like this. Most of the volume would be in the middle, and the least amount of volume would be towards the edges. You guys get the drill. Or maybe you don't. Masterclass link in the description. Let me do volume, session, market profile, or volume profile. Let's see if this one works. No. You guys have a volume profile that you use? Oh, here it is. It's pretty good. Okay, so you'll see where most of the trading activity is going to have, most of the volume is going to happen inside of this range. It's also where most of the money gets lost. You see all these wicks here. A lot of stop losses are getting hit in this region. Very few people are trading, so I'm not going to go into too much detail, but you guys get the drift. And so if that's my average trading range, then what is this right here? Nope, not Apple Music. What is this right here? I'll even color code it for everybody. Beautiful, Ashlyn. Awesome. And then what would make this top range right here? Beautiful. Okay. And so this is how to have an understanding out of chaos. So if we had looked at this before, looks random. Looks like a lot of up and down. I don't know what the market is doing. The market's crazy. You guys are on social media. You see what people say. TP2 just got demolished. Perfect rejection. Perfect rejections here. You love to see it. You love to see it. You love to see it. I have to adjust my fib just a little bit here. Oh my. A little bit of pain. A little bit of pain is being felt in my chest, right? I feel that. I understand, right? It hurts sometimes. I'll actually put in a crazy bet that will go to TP3. It's not that crazy because there's no money on the line. Bobby said I'm out with 2% for the day. Closed all positions. Let's go. And that's how you end the week, Bobby. I took the sell, but oh my, that buy was double up. Beautiful. It's probably a sell somewhere in here right now. Big 88% right here. Little sell skis right here. Right down. Okay, so from here, might get inverted head and shoulders and push. Or if we close below the zone, we have candles closing below this area, then we can actually push down for an even deeper retracement. Okay, we're going to cover the Fed meeting here in a second, y'all. It's very important. We're here to make money, and so money making comes first. Trade is unwound. Trade is done. I don't even want to mess with this trading panel anymore. Thing is horrendous. So now we can cover Fed meeting predictions and some of the kind of expectations going into X/Twitter. Twitter is incredible for keeping up with news. For trading and for traders, it is the last place that anybody should be. When I first hopped on Twitter, I was so happy to get out of the Instagram kind of like world and get around all these new and hungry traders. Everybody was posting analysis, free trades. And then it quickly kind of became a cesspool of kind of influencers with badges promoting, sketchy companies. And then it just kind of got way out of hand. And then it started to get into like beefing and trolling. And then all like the serious people seem to have left. And it's only the trolls and the haters left on there. Like nobody should be that miserable, right? And nobody who's that miserable should have a platform or have a fucking place like Twitter. Okay, because that is just not healthy for anybody. I personally don't like using Twitter. We might have somebody on the team get on there. Only reason I still use it is to keep up with these live stream trades. Okay, these live stream trades, I post the before and afters on Twitter just so everyone can keep track of how often this is successful. What I'd rather do is we're going to open a free Telegram for all you guys to join, and I'm pretty sure we already created the Telegram group. We just have to kind of put on some finishing touches there, and you guys will just keep up with all the trades there. All right, this thing is ripping. Lord have mercy. This is insane. This is absolutely nuts. Okay. I might need a coffee break or something. I have to go get one of those Zen packs or something. By the way, Bryce, and Bryce's not even on here, but I gotta give him a hard time. Got me on these fucking Zen packs. These things are amazing. Funny enough, the interview that we had at the New York Stock Exchange, which by the way, shout out to you guys. We got over almost 1 million or almost 500, what is it, 550,000 views on that video. You guys are absolutely nuts. 550,000 views on this video. What you guys might not have noticed is I had a Zen in while I was conducting this interview. That's why it's so incredible and so wildly successful. It's that focus. This is not a paid advertisement. This is your boys just got issues, I guess. All right, let's go through the article here. If you guys have questions while we cover this, I know it's going to be a bit heavy, but I'll try to keep it as simple as possible. This article was more just to cover all the bases because we have some investors that follow the channel. We have mostly traders, obviously, because we're day trading on here. But there's also folks just interested in the economy in general. And so I tried to kind of cover all the bases, impacts on traders, consumers, markets, some risks, because we're risk managers first, and then kind of just summed it up at the end. So we'll cover this. If you guys want something to take notes with, I'm going to give you guys my predictions for the Fed meeting later, as well as kind of the trade idea that I'm watching for later. Go grab something to take notes with or grab some coffee. I'm going to go grab some coffee. Should I play something in the background? I'll probably play something in the background while I go get this coffee. Let's see what made this video so successful. I'm guessing 550,000 views. A lot of you may have seen that video. Let's watch something that doesn't have a lot of views, but I feel like deserves more attention. What is this one? Oh, this is a playlist. So this is from my interview with TradingView. I want to find something short and sweet. These TradingView videos are actually pretty short. Okay, do you guys want to watch the end of the prop firm kind of era? Kind of speaking from TradingView's perspective, you guys want to watch the prop firm wars, Oanda versus IC markets, kind of what the big players are likely to do in the prop firm space. Would you guys like to watch one of the interviews from our successful students? Kind of see what these are a bit longer though. Yeah, the short clips is probably what we got. Or QB Stu's opening speech at the FX Summit. There's so many great videos here that do not get enough love. Oh, Bob Elliott. That might be one worth kind of clipping into. Definitely, you won't be in the waiting area. I got you. Don't worry. Okay, let's see if I can play something from the Bob Elliott podcast. Where is it? Where's Big Bob? Oh, here it is. And let's see if I can kind of cut forward to a part where they're speaking about the Fed meeting specifically. Okay. All weather approach, alpha, chasing a high sensitivity, coaching traders, macro, wage, income, unemployment. Okay. Unemployment is about 8 minutes convo. Fed and the Treasury, quantitative tightening. Oh, let's go. All right. Let me know in the chats how's the audio on this.
That's like, what are the after effects of that? And how significant? Okay, well, I don't know how you did that, but you read my mind on the next question. Because you mentioned bonds, and if we're gonna
No, I know what you guys are going to
talk
be asking
about
here in a second, which is probably the most important piece of that video specifically. Wow. I'm actually going to put a second alert here because if we get a re-entry at this this kind of, some of you might not be able to see this, but if you guys look at this inverted head and shoulders situation here, if you get a 50% retest of this candle, wow. Yeah, I'd like that a lot. I'd like that a lot. So I'm actually going to put an alert right there, just so I can focus on flipping around different pages and not have to sort of worry about missing a move or not. But I know what you guys are going to be asking about this interview. Just kind of cut to the chase. Roy, what's the arm routine to get biceps like that? Look, honestly, it's genetics. Don't even try. Might as well just quit while you're ahead. I just want to get that one out of the way. For the sake of time,
I think we don't have a great sense as to all the second and third order concepts.
Max, you're laughing like that wasn't the number one question on everybody's mind from start to finish. Like, let's just be real here. My job is to kind of look around the corner. I get it. I got you guys. Don't worry.
But the reality is it hasn't been big enough to influence some of these larger macroeconomic drivers. It's just been kind of sitting in the background, just kind of plugging away, just not a big enough deal. And if anything, what's been a much bigger deal has been the Treasury and the debt profile and issuance of the Treasury, which has basically taken taken monetary policy, which is typically done by the Federal Reserve, and put it in the hands of the Treasury, where they've gone from periods of issuing, the U.S. running a pretty big level of deficit, but there's been a lot of volatility in terms of how many bonds they're issuing. Part of it was because there was a debt ceiling issue; they couldn't issue a lot of debt, and then.
But that's money printing now. Essentially, is that the creation of bonds out of thin air, and then the creation of money out of thin air. It's sort of like a trade between the Fed and the Treasury. Right? It's kind of like the back end.
Yeah, I mean, it's just, if you think about it this way, when you issue a bond, right, you're selling bonds. Which means you're selling assets. Yeah. And so at some level, it's relatively, it's no more complicated than that, which is, in general, the US federal government is selling bonds on a consistent basis, right? Because in general, they're running deficits. But if the volatility of their sales of bonds is moving around a lot, the Fed's volatility of their balance sheet isn't really significant. It's just kind of meandering down, right? The Treasury's volatility in their balance sheet and how much they're issuing is moving around a fair amount because of a lot of these idiosyncratic factors and policy decisions. And so the reality is what the Treasury is doing matters a lot more than what the Fed's doing, and because of just the nature in which that volatility has happened. And it's very different in the pre-COVID period. Basically, what happened, particularly with longer term Treasury bonds, is the Treasury basically just issued the same number every quarter. Because the Treasury is not trying to game the system here and trying to sell more here and sell less here and try and affect interest rates. It's not like the technocrats in the Treasury. I mean, these are like accounting nerds. That's they're like figuring out. That's what they're doing. They're technocrats.
This is a belief that there's no politicization in some of these agencies, and I guess it would be pretty tough to argue, especially with Janet Yellen's relationship with the Fed, the kind of common interests of the policies between the Fed and the Treasury today. Would you say that just because of common interest, they seem to be working in tandem in a way that might be inflationary or might create more problems down the line?
I think I'd probably separate it. The Treasury is a political institution.
First off, I have no idea where I'm pulling these questions out of, people, because there was no questions written down for this interview. That was a solid fucking question. And Bob just kind of shutting it down and kind of telling it how it is and being like, hey, that's a good point. And as smart as that sounds, that's not really the reality. That's why you need very successful people around you and people who have that knowledge and wisdom to be able to, you can really start to build a delusion in your head and kind of start to think that there's relationships and patterns between things. But really, Yeah, having informed people around you will always set you straight and save you years of headache.
Appointed by the existing administration, and it has, well, in the sort of, I don't know,
So
last
was the
couple,
Fed chairman.
okay,
Sorry. I'll let you finish.
in the last couple of decades, it has not been a big domestic financial system policy creator, incremental policy creator. It has, if you look over the course of the last 250 years, there are times in which the Treasury is implementing political policy through the way in which it's thinking about its debt profiles and engaging there. And we're kind of back to the future in that sense, which is what Janet Yellen's doing today in terms of having meaningful Treasury policy shifts, particularly in response to how they're seeing it in the bond market action. That is unusual for most of our careers, but commonplace over the course of U.S. history.
Understood.
And so she is a political figure in a political role, implementing policy. Now, there's a lot of speculation about the Federal Reserve and whether you think about them, how much you should think about them as a political entity. I mean, there's no entity in the world is apolitical. But my experience, I would say, and being pretty close to it, to the people who are there running policy and thinking about policy, is that the Federal Reserve is not.
Did you guys catch that little subtle flex? It's like, I'm pretty close with obviously he's not going to say that they consult top economists in the world, the folks at the Fed, but that's basically what they do. And Bob is one of the top economists in the country for sure, and probably one of the top economists in the world, because he really does have that. I mean, he was the head of Ray Dalio's personal investment team at Bridgewater and Associates. That's the #1 hedge fund in the world. He was the head of the forex division for about 5 years. He does understand global markets and analyzing global markets probably better than 99.999% of the human population. And so a little subtle flex there about, he knows the people at the Fed and how they think, which is really, really solid insight here.
Primarily a political institution and is primarily trying to focus on their mandate and trying to be, influenced by the data and trying to create policy around that data as much as they can. So I wouldn't primarily, the thought that like, hey, what's going to happen, as an example, is that Joe Biden's going to call up, Jerome Powell and say, ease the shit out of the economy so I can win the election.
Well, that's why I say it's more.
That's not really how it works.
I would say it's more of like a common interest thing, which is why I kind of phrased it that way, because and this is kind of the common narrative, is a lot of this stuff is not some conspiracy of people in a room working together, but it's like-minded interest where there's just an unspoken understanding that we need to keep the economy stable in a year as important as this, and taking risky action by the Fed that could potentially hurt employment, for example, would be destructive to everybody. And maybe we should stay away from some of these more extreme policies and kind of stick to this path we have right now. Do you think that that's a factor? Or do you think that the Fed really does have enough, independence to be apolitical?
Well, I think we're already seeing it in the sense of there has been a divergence between the policies that the Treasury has tried to implement, been implementing, which is much more politically oriented than what the Fed has implemented. Like, look, if growth continues to be as strong as it's been, unemployment continues to be where it is, and inflation continues to be a concern, the Fed will not ease, through to the election point.
Gotcha.
And they, to be clear, they've said as much.
Yeah.
Right. And so if the Fed was predominantly pursuing growth stimulation, that wouldn't be their approach, right?
Okay. I would say it's stability. So it's kind of like how when you have money, how you want to keep it, and so you're not taking any risks, versus when you're starting off, you want to take higher risk. I think because of the position they're in, maybe they don't want to take an action that could maybe be a better fix or a better path, because this path is a much more predictable or much more safe.
Yeah, I think part of what you're highlighting is that if you look through the history of central banking, the first law of central banking is that central banks do a lot less than what they say that they're going to do. That's the first law.
Yeah.
Okay, so that's actually really crucial, especially for today, because the narrative is that they're kind of talking, they're floating around the idea of a 50 basis point cut. and they're talking about how much they're going to, you know, sort of the steps they're going to take forward, but they usually do a lot less than that because they want to set the expectations really high, let the markets overreact a little bit in advance. That way, when they release the news, there's sort of this relief, and they always kind of stay ahead of that market reaction.
And it's kind of a joke on the inertial law of Newton, right? So that is, you know, in general, central banks are very slow moving, and there's a variety of different reasons why that is. One is they're generally consensus.
All right, my coffee's done. I'm going to go grab it real quick. I'll be right back, and then we'll cover this article, and we'll kind of cover my predictions for what the market's going to do and really what Jerome Powell is likely to do. Now, 25 basis point cut is, I think, the expectation here, but it's more about what Jerome Powell is going to say and then what questions he's not going to answer. That's more important. That's going to drive serious market reactions when they ask, you know, if the labor market's weak, but inflation is now under control, or you're going to start cutting and sort of switching your priority between employment and inflation. And I think that Jerome Powell is going to say data dependent, and we're still, you know, we have a dual mandate to do both. But it's really important about which one the Fed is prioritizing right now. If they're prioritizing inflation, they're going to raise rates. They got to get the economy slowed down. But if the labor market is weakening, which is what's happening now, then they have to shift over to cutting rates and stimulating the economy. Two completely different paths forward. And so I think that's going to be the number one topic to gauge. He's not going to say it directly, but we'll have to kind of read in between the lines to figure out if the Fed is going to start prioritizing employment going into 2025, which is very bullish for stocks in the long term. So like probably after the elections, we're probably going to have a crazy bull run if the Fed is really prioritizing saving the labor market. All right, give me a few minutes. Be right back. Stick around.
Based organizations rather than voting, or they're literal votes, but their decision making is predominantly consensus oriented. So what that means is you have to have a consensus. You have to convince the very last person, the slowest moving person,
which takes time. It's like jury duty.
Exactly.
Yeah,
exactly.
yeah.
That's exactly right. And then on top of it, you're generally data driven, and it just functionally takes time for data to emerge.
Like
right?
you said, there's too many fluctuations in the market on a day by day, which is why the longer term.
Exactly. So what they're doing is they're taking lagged data. They need to see a fair amount of it, and then they need to develop a consensus around the policy that they're choosing. And so you put all those things together, and almost structurally, central banks are just slow moving entities. And particularly in circumstances where there isn't an obvious growth problem, they're generally very slow moving. Because if you're the Fed, like, really, what is the cost? If unemployment's at 3.8% and has been for the last 18 months and isn't really moving around very much, what is the cost?
You can just go and focus on your second mandate, and you don't really have to do anything else to really mess with it.
There's no reason to move quickly. And I think people too often think, for instance, in that two mandate system, the inflation and the growth, they think that the level of responsiveness to both is the same, and it's not the same. If growth is deteriorating rapidly, the Fed will cut interest rates rapidly.
Okay,
right?
huh.
But if inflation is moving towards their mandate, that's great, but there's no urgency to cut interest rates.
So the only reason that inflation is on the front burner is because of how severe the current circumstances. Like otherwise, growth and employment would be their number one priority.
Is the sort of thing that causes them to act with urgency.
And that's a perfect segue, because where we're at right now is that we have reached that tipping point where inflation's finally back down, or at least according to the government numbers. Nobody actually thinks prices are back down. But because the employment situation is now kind of let me just show you guys the data here on the Fed's website. So we'll go Fred. Nope, let's go homepage. Okay. Let me show you the difference between CPI, and we'll open these actually in different tabs. And then inflation, and then unemployment. Perfect. All urban consumers, city average, median consumer price index. Okay. All right, so let's look at the unemployment rate, and we've been talking about this for such a long time. I'm here on the St. Louis Fed's website. This is the Federal Reserve Economic Data website, FRED. Yeah, this is one of the main kind of data tools I use to understand the Fed, because this is really what they're using to make their decisions. So if you guys see here, 3.2 to 3.6% is the historical floor. That's the historical low. These gray bars represent recessions. You guys have heard me go through this before. Okay, right before a recession, typically what you have is a period of record low unemployment. Typically, before you have a recession, you have a period of record low unemployment, followed by recession, record low unemployment, followed by recession, record low unemployment, followed by recession, record low unemployment. This was COVID. That's why the unemployment rate got up to 15%, and it was actually a lot higher. Now we have this period again of record low unemployment, and we're very likely to sort of reach a recessionary stage unless the Federal Reserve can get ahead of this and avoid this unemployment disaster. Okay, so we're back at the dips. Right after the dips, we usually have a recession in the following year, excuse me. So 2007, 2006, that's when we had the record lows. At the tail end of 2007, going into 2008, that's where we kind of got that recession. And it lasted till about 2009. This is the Great Recession, the GFC right here. We also have the dot-com bubble. So you guys can see 1999 to 2000, we kind of bottomed out. Then from 2001 to 2002, that was the dot-com crash. That's where we had massive recession. Here, COVID was actually really quick. The recovery was one of the fastest we'd ever seen. The response to the economic problem was handled really well, honestly. Shutting down businesses and things honestly could have been avoided, but I think printing a lot of money and pushing trillions and trillions of dollars into the economy was probably a good bet. At least in the short term. In the long term, we're fucked. Now, we've had from 2022 to 2023, we've had that record low unemployment. And then from here in the 2024 area, we've kind of started to make that dip up. So we actually could see an unemployment spike going into 2025. And then 2026, we sort of come back down. There's a very good shot here that we enter a recession unless the Fed gets ahead of it. We're lucky that you have access to this kind of info and able to share it with us. Walter, I'm grateful too, bro. I'm unbelievably grateful for the connections that we've been able to have, and we'll continue to build because it's only gotten bigger and better. And these are just incredible people to be connected with. You're 100% right. Wow. That was the retest right there, a little mini shoulder right here. We could actually see this thing push all the way up to the top of the range now. So I'm out of the markets until the Fed meeting or until after the Fed meeting. And that's going to be my personal take. Members, what I'm noticing here. Okay, so we had this consolidation range here already got tested. So if you guys can see, we actually had a break and another break, and then we kind of had this release. This overall extended move, I think, is part of this bigger range like this here, in which case we actually had a push above first, break below second, and potential continuation to the 88.6 up here. So big range. Real easy stuff. We go right here. Right there. And I'll have to scroll down here a bit just to find the bodies. Everybody's gonna be closer to right there. Do I really want to be on the 1 minute chart? Okay. That's our range. So let's talk levels. Yeah, 17 or 19,580. 19,580. 19,580, 19,580. That's going to be that sell level. It's going to be that sort of final target. And then just look at this beauty. I had a quick reversal on the fibs. Look at the downside. So we have perfect entry price right here for shorts, perfect entry price right here for longs, and just does not get better than this. Incredible. Okay, so we have a top side, we have an upside target. Retest on the downside, this is where we're going to have to use a smaller range. And so for the members out there, then we're going to have to use this top side range, this bottom side range, which we've already tested. Find the true body. Line up the levels. So if we flip this one around, then this becomes that new sell level. 19,500. Okay, so we get to 19,500. We get a bit of a reversal back down. And if we're lucky, we get this little inverse head and shoulders movement right here. It goes here, here, and straight up to 19,580. Okay. Members, did that make sense? I know it's a little bit all over the place, but we got options everywhere. And then whenever the market sort of leaves the station, I use that in like air quotes, you always just want to look at the next potential target. So one last thing is that zone that I just showed you guys, okay, that is the extension level from this smaller fib, like this fib that we were trading this morning. Okay, so the extension level up here lines up with the fib level that we drew from top to bottom, which is right here. Let me clean this up. Let me add one level real quick. Oh, you can add text to this. I don't know why I keep forgetting you can add text. Wow. Why have I not been using this feature? There's some clown activities here. Huh, that's awesome. Okay, so it's actually not the extension. I was capping. Is it the negative 61 extension? How does this make any sense? Okay, well, anyways, that's going to be the level, 19,585. Okay, so we'll actually add a text there. Wow. On today's episode of Trades I Should Have Held, we got that right here. We got about 130 people watching. Make sure to hit the like button. Let's actually go through predictions here, not just for the markets themselves, but let's talk about Fed meeting predictions. So I'll give you guys the two options. Option number one. Actually, we'll do this while this chart. Wow. Talk about an early closure. This is like a snow day in high school, bro. This is crazy. Closed earlier than a fucking retail store on Fridays. Oh God. But then again, still 2 p.m. might be intense. Yeah. I'm not, man, look, we made money. All right. It's moving now. Nope, not gonna take the shorts. Not gonna take the shorts. It's at the sell zone. It's coming up and hugging that thing. Not gonna do it. Okay. Let's talk about the two options. No more. There's technically three options, but the main two are going to be right here. So the first one is my expectation of 25 basis point cut. Okay. And then over here we'll have probabilities. We'll do this in different color. Can I rotate this? Why can't you rotate these? Okay, whatever. Probabilities are going to be right here. So for the 25 basis point cut, I'll put about a 70% chance. This is my kind of my base case scenario. Probabilities, and then I'll do the effect. Effect on stocks. Okay. So we have about a 70% chance of getting a 25 basis point cut today. The effect on stocks is going to be short-term bullish, medium-term bearish, medium-term meaning 1 to 2 months, and long-term bullish. This means after 1 to 2 months. Clear? Okay, let's keep this going. Take this over here. You know, this actually could be closer to 60. And this will be 2020. All right. So the effect of a 50 basis point cut, same exact thing. Actually, this would be short-term bearish, medium-term bearish, long-term bullish. Why would a 50 basis point cut be worse for markets than a 25 basis point cut? Because this one is already priced in. Just remember, news is all about expectations. So the expectations of these economists, and then the reality of what actually happened. And how far apart those two things are between the expectation and the reality, that's how volatile the market reaction will be. And so because the market's already priced in the 25 basis point cut, nobody's really been looking at the 50 basis point scenario. The only reason that they would do a 50 basis point cut is if the economy is so bad, if we're so close to a recession or already in one, that they don't have a choice, which would signal to the markets, hey, things are a lot worse than you think. And that will make the markets panic. And so that's when we have same exact thing, except in the short term, it'll just be bearish because the reaction will be so far apart from the expectation that the markets will overreact instantly. And if there's no rate cuts, this one's actually very tough. This one, I'll leave as undecided because I don't know how the market will react in the short term to no cuts. I think it'll be a relief that, okay, if the economy is not so bad, that we don't even need one rate cut, that means that we've done the soft landing. So that should be a nice bullish recovery for everyone. But because the expectations are the 25 cut, just the fact that it's off of the expectations, it might make the markets sell off just in case. Now, I do think that we have the medium term bearish, like for like a month or two leading up to the elections. I do think that's a possibility. So I'm keeping the medium term bearish outlook for almost whatever happens today. Okay. He said price is booming. Is it still going? Oh my God. Pain. Did it just hit the 886? This is really solid. I'm going to clip this right here. Put this one in the vault. Okay. And we just hit the sell zone. What do you guys think? Quick sell skis down to 460. I'm closing the paper trade, by the way. This thing went too close to TP, didn't hit. Go ahead and close that full trade. All right, I got too many fibs. I got too many fibs, too many fibs, too many fibs. All right, sorry guys, I have to handle something real quick. Okay, back up. So I think we see this retracement down till about 19,460 level. And then if we get caught here with the inverted head and shoulders, I'd love to use that as a new buying spot right there. Just want to know, what if they raise rates? It's not even possible. If they raise rates, then that's a guarantee recession. If they wanted to guarantee a recession today and they want unemployment to just fall out of the sky, or they wanted to unemployment, excuse me, to just skyrocket, then yeah, that's what they would do, is they would raise rates. Because inflation is already at 2.5%, so there's no reason to do anything more aggressive on the inflation front. You can just let it ride and let the work that they've already done kind of do the rest. But if they raised rates, then yeah, that would crack the employment market instantly, which I just don't think they would do. Not gonna do it. All right, I might do it. If I see one more push up, like I just want to see a candle break these two candles right here on the 5-minute and then wick below. If I see that, I'll entertain the shorts. If not, then I'll just let this thing ride down, and I can just pick it up on the retest. I'm thinking below this area here. So I'm thinking like real inverted head and shoulders, real 440. 19,440. I was thinking a quick spike up to the equal highs before sells come in. I could see that too, but if it like by the time it breaks this consolidation right here, by the time we break out of that average trading range, it's going to be heading to the upside. And so when you hit that 88, we had the first and the second touches already. So we had this first kind of push up, and then this is where the best entries would be, as close to these wicks as possible now. So the only sell entries would have to be as close to those as possible. And equal highs, you mean up here? We've already had, excuse me, we've already had duck, duck. The next time might be goose. My guy Roy gives the best economic breakdowns. Appreciate you, brother. What time does the meeting start? So the report's going to come out. The statement comes out at 2 p.m. Eastern, which is in about 50 minutes. And then 2:30 p.m. Eastern is the Fed meeting itself, which is in about an hour and a half. Will it affect the Bitcoin price? Good question. The answer is yes, because what it's going to do is it will affect the dollar, and the dollar affects everything else. Because when you see the dollar, let's see, the dollar's been dumping, let's say on the 4 hour. So since whatever this is September 10th, we've kind of been on this bearish retracement. What you'll typically notice is that since September, right before September 10th, we've started to see an uptick in Bitcoin. So typically what we'll find is that the dollar and the commodities, and I'm kind of throwing Bitcoin in the commodities pile right now with gold and silver and those, typically counter correlated. They move opposite with the dollar. So the DXY sees a bounce here from this weekly support level. And we already have the super secret magnet indicator sort of giving us this indication of the next levels that are likely to get hit. And so if the dollar sees this bounce, plays around here, and then sees a bounce to the upside, then we're going to see Bitcoin's price come down. We'll see gold's price come down. So Bitcoin's at a pretty important level of resistance. And so that one actually wouldn't be that unexpected. Gold here, on the other hand, there's really two options for gold. So gold's forming the support. If it's going to fly, it's going to continue to create support here, and then it's going to break through aggressively and then continue. So members, we got the duck, duck, goose here for a shallow retest. So option one is shallow retest. Option two is deep retest. Back inside the range, maybe to an area of support, and then a continuation of that trend. Okay, so this really all depends on how the dollar reacts. If we continue to hold that support right at the news, we're going to see a spike in either direction. So if you see a spike down, typically the next move will be up. And then same with gold. If we see a massive spike up on gold during the news, then we'll typically see, or we see a massive candle up, we'll typically see it wick back down or correct back down aggressively after. So whichever way the market fakes first, we do the opposite. Don't fall for the pump fake. And that's it. Roy Ray, brother, again, I'm going to tell you the same thing I told Roy Chung. This town's not big enough for the both of us. What's your crypto dark horse? I don't even know what that means. You even put an emoji, bro. What's up, Mike? Who are they? Who's they? When is the Fed gonna let us know? 2:30. Hit the like button. That person's got their priorities straight. Do I use other platforms to keep up with the latest news? Not really, no. James Roberts says LOL, rip off. Okay. Yeah, if I can't make sense of your comment because it's not a full sentence or it's not like an intelligible thing, I ain't gonna respond to it. I'm not here. I got enough to decipher with the markets. Last thing I gotta do is decipher what you're saying. All right, we had a break and closure below the 88.6 here on USD JPY, but I could see this thing recovering. I could see this thing recovering. So it really just depends again on the dollar. We might even have one more move down on UJ just to kind of hit this double bottom and then recover and test. But 141.4, that is the ideal entry zone. Ideal entry zone. Put a paper trade here just to track this thing. We'll keep track of this. I do have to clean up my charts because I'm going to have to come back to these later. I'll keep that one. Euro USD shorts. We were talking about this. This one's pretty straightforward here. We might see a spike up for a double top before we drop here, but this is a pretty solid entry price, 1.13. 113. And last but not least, let's get back to the regularly scheduled programming. My God, this is way too messy. Are the shorts coming in? Yeah, kinda. Struggling a bit. Oh, not Apex's feed lagging. Oh no. Oh, scalping trick for the members here. This is your mini range. And so we have let's say A, B, and C. Where's the best entries? The best entries and honestly the only entries. Is it as the market's dropping and you're like, oh, it's going to keep dropping. Let me enter now. Is that where we enter? Which letter is the best entry? It should be automatic, people. It should be automatic. It's not a trick question. No, I put 3 letters up, Devin. 3 letters. Which letter is the best entry? For sells, not for buys. For sells. Excuse me. Okay, beautiful. Okay, because what most people want to do is they want to wait for the market to start dropping so they get that confidence, that confirmation, and then they start entering as the market's already down here. What will happen is they'll enter here and they'll get caught in a potential retest back up, which is exactly what we're seeing here. Or this thing might just drip out the sky. Oh. Oh, the markets. These buys were beautiful. Hmm. Strategy is too accurate. All right, y'all. So here's what I'm gonna do. We'll hop off this stream and then we'll check back in right before the Fed meeting. How does that sound? Deal? Make sure you guys hit the like button on the way out. Again, quick reminder, if you guys are in London, have friends in London, if you guys are anywhere near the UK, pop out. We're doing a workshop October 2nd or October 3rd. We'll keep you guys posted on the exact dates there. Make sure you guys register, use promo code Chartaddicts for all tickets to the FX Summit. And then if you guys are going, make sure to tag FX Summit on your Instagram story. Let us know that you grabbed your ticket. All right. To get the full article of kind of my predictions for the Fed meeting, head over to Chartaddicts FX and make sure to subscribe to the newsletter at the bottom. As you guys know, our Instagram got taken down. So to keep up with all updates, know when we go live, and to get free analysis, make sure to hit that subscribe to the newsletter at the bottom of the website. See you guys there. All the links are in the description of this YouTube, kind of whatever this is, the YouTube stream. And of course, if you guys want a funded account, I'm using Apex. As you guys can see here, I'm trading on Tradeovate here with Apex funding. That link is in the description below. You can use code ChartAddicts on Apex Trader funding as well for 80% off all challenges. That means $200 accounts are now $40. Something to take advantage of. All right. See you guys later. Catch you in about 30 minutes or 45 minutes. Happy and safe trading. Peace. All right, members, I'll be checking back in here in about, call it half an hour. So take a